Florida was supposed to be the pandemic's biggest real estate winner, and for a while, it was. Remote workers flooded in from New York, California, and Chicago. Investors snatched up rental properties. Retirees turned part-time vacations into permanent moves. Prices surged. Inventory evaporated. The Sunshine State became the hottest housing market in the country. That wave has now crashed, and what is being left behind is a market under pressure in ways that most national headlines are still not fully capturing. The signs are visible across the state. Homes sitting on the market for months instead of days. Sellers cutting prices on listings that would have triggered bidding wars 2 years ago. Buyers walking away mid-deal when the full cost of ownership, mortgage, insurance, property taxes, HOA fees lands on the table, and the math stops working. Inventory across Florida has jumped more than 70% since late 2023. In some metros, the number of active listings has doubled. Insurance premiums that were once a footnote in the home buying conversation now average between $6,000 and $10,000 annually, a 50% increase since 2022. With mortgage rates near 7%, even well-qualified buyers are being priced out of markets they could have entered comfortably just 3 years ago. This is part of our Housing and Cost of Living series. This video counts down the 10 Florida cities most at risk of a significant housing correction in 2025, starting at number 10 and building to the city that data suggests is most exposed. Some of these will surprise you. Others have appeared on every real estate investor list for the past 3 years. After this breakdown, the picture of Florida real estate will look very different. Number 10, Fort Lauderdale. Fort Lauderdale built its identity around glamour, turquoise water, luxury yachts, and the kind of waterfront lifestyle that commanded premium prices without much resistance. For years, that identity held in the housing market. Investors, retirees, and remote workers paid top dollar to be part of it. But in 2025, the premium is eroding faster than the city's reputation can absorb. Inventory has surged more than 80% year over year, flooding the market with listings that are not moving. Homes that sold for $650,000 in 2023 are now sitting unsold at $580,000 with few offers in sight. Properties that used to sell over a weekend now linger for months. The insurance crisis is front and center here. The average homeowner now pays over $7,000 annually, a 50% increase since 2022. HOA fees in many buildings run above $500 per month. The combined carrying cost of ownership has crossed a threshold where the lifestyle premium no longer justifies the financial burden for a growing share of potential buyers. Investor activity has fallen sharply. Roughly 30% of investor-owned condos are now listed below their original purchase price. Airbnb hosts are feeling the pressure too, with occupancy rates down 12% year over year. Many short-term rental owners are trying to exit before values decline further. Fort Lauderdale still looks like paradise from the water. Beneath the surface, affordability is collapsing and confidence is leaving with it. Number 9. Cape Coral. They called it the Venice of America, a city built on canals, sunshine, and what felt like unlimited growth potential. Cape Coral was one of the fastest growing housing markets in the country. Between 2021 and 2023, active listings exploded from around 1,800 to nearly 4,000 homes. Demand seemed impossible to satisfy. Developers could not pour foundations fast enough. That era is over. The market is now oversupplied and underbought. Home prices have slipped 5 to 7% year over year. Houses that attracted bidding wars are sitting for 70 or more days with no serious offers. The culprit is overbuilding developers raced to cash in on pandemic migration and flooded the market with inventory that simply does not have enough buyers anymore. The cost of ownership in Cape Coral has become genuinely severe. Flood insurance premiums now run between $8,000 and $12,000 per year for many properties, if coverage can be found at all. The city's infamous utility expansion fees add another layer of burden, with some homeowners paying over $30,000 just to connect to city water and sewer systems. Cape Coral's economy is heavily tied to construction and tourism, neither of which provides the diversified employment base needed to support inflated home values when migration slows. Half-finished subdivisions, price cuts on every block, and open houses with no foot traffic have become common. From the air, Cape Coral still looks like paradise. On the ground, the market is showing its first real structural cracks. Number 8, Ocala. Ocala was supposed to be the safe bet inland, affordable, and insulated from the coastal volatility that made Miami and Fort Lauderdale so unpredictable. Horse country charm, quiet neighborhoods, lower price points. For a moment during the pandemic migration boom, it worked exactly as advertised. Then, developers noticed, and everything changed. Active listings have surged from roughly 800 to nearly 3,000, a 275% increase that represents not growth, but saturation. Homes that sold for $310,000 in 2023 now sit at $275,000 and still cannot find buyers. Entire neighborhoods, particularly around Silver Spring shores, feel half-empty ghost suburbs born from pandemic optimism and abandoned when rates rose. Between 2020 and 2023, home values in Ocala climbed more than 55%, while local incomes barely moved. The economy is rooted in agriculture, manufacturing, and warehousing sectors where wage growth has not kept pace with what the housing market decided homes were worth. Insurance costs, rising statewide, have pushed even Ocala's once affordable homes toward the edge of what local incomes can support. The very quality that drew buyers here, affordability, has quietly vanished. Ocala still offers real beauty and a slower pace of life. But the market it built on pandemic momentum is deflating toward its pre-boom reality. Number 7. Tampa. Tampa spent several years as Florida's golden child, a booming metro, where the tech sector, sports culture, and real estate investment all converged into one compelling growth story. Between 2023 and 2025, active listings climbed from fewer than 3,000 to more than 4,500 homes, an 80% surge, driven by the same overbuilding that is weighing on markets across the state. The affordability math has broken down sharply. Mortgage rates near 7% have pushed monthly payments on median-priced homes up more than 40% from where they were at the peak of the buying frenzy. Property taxes and insurance premiums have both risen more than 40% since 2023, turning homes that once looked like solid, long-term investments into monthly financial commitments that many buyers are no longer comfortable making. Zillow data shows modest monthly price declines, but local agents describe something more significant: investors listing properties at 5 to 10% losses just to exit before conditions deteriorate further. The short-term rental market that once generated strong returns for investors has plateaued as tourism growth slowed and local renters cannot afford the price floor that pandemic-era purchases require. Homes that sold in under 20 days now sit for more than 40. Builders are offering rate buydowns and closing credits to move inventory that is not moving on its own. Tampa's fundamentals: beaches, professional sports, a real urban core, remain intact, but the momentum that defined the market for 3 years has broken. Number 6. Jacksonville. Jacksonville, Florida's largest city by land area, built its housing reputation on stability. Where Miami was volatile and Tampa was trendy, Jacksonville was steady, family-friendly, and insulated from the extremes. That reputation is now being tested. Active listings across the metro have grown from approximately 2,200 to nearly 4,000 homes, an increase of more than 70% in 2 years. Prices have not collapsed, but the pressure is building and the structural causes are not temporary. Builders went aggressively into suburban expansion in areas like Orange Park and Middleburg, anticipating demand from out-of-state migration that has slowed considerably. Fitch Ratings estimates Jacksonville homes remain approximately 26% overvalued relative to local income levels, a gap the local economy is not growing fast enough to close. The logistics and shipping industry, a key economic pillar, has seen port cargo volume drop 14%, tightening both employment and loan qualification across the region. Flood insurance premiums have climbed more than 60% in some neighborhoods. Investor concentration is a compounding problem. Roughly 1 in 5 homes is investor-owned, and that segment is generating a steady stream of price reductions as owners reassess whether the returns justify continued holding. Jacksonville's geographic diversity and long-term appeal remain real. But in 2025, it is a market where supply has outrun the demand available to absorb it. Number 5. Sarasota. Sarasota built its housing market on a specific kind of buyer: affluent, selective, and patient. White sand beaches, world-class arts, and waterfront properties that held their value through multiple cycles. The assumption was that the luxury segment was insulated from the pressures hitting more affordable markets. That assumption is being tested directly in 2025. Inventory has more than doubled in 2 years, climbing to over 3,700 active listings. Waterfront homes that sold for $1.2 million in 2022 are being relisted closer to $975,000. Even at those prices, they are sitting. The correction began as inflation and stock market volatility in 2024 prompted high-end buyers to pause and reassess. Then, rising mortgage rates near 7%, combined with insurance premiums reaching $8,000 to $10,000 annually, created conditions where even well-resourced buyers started questioning whether the numbers made sense. Median days on market in Sarasota have stretched beyond 90. Sellers are staging elaborate open houses, offering credits, and in some cases, making price reductions that would have been unthinkable 2 years ago. Sarasota's amenities, Siesta Key, the Ringling Museum, a genuine arts community, are not going anywhere, but the momentum that sustained premium prices through the pandemic era has stalled. For a market that ran entirely on confidence, that pause has real consequences. Number 4. Port Street Lucy. Port Street. Lucy positioned itself as the affordable alternative, the city where buyers who could not compete in Miami or Palm Beach could find space, quiet, and reasonable prices without sacrificing coastal proximity. That positioning worked during the pandemic boom. It is now working against the city as the gap between its prices and its economic fundamentals becomes increasingly difficult to ignore. Florida Atlantic University research puts Port St. Lucie home prices at approximately 41% above their long-term fair market value. The median price reached $410,000 at the peak, while average household income in the area sits around $62,000. That gap is not sustainable without either significant income growth or significant price correction, and income growth is not arriving fast enough. Inventory has climbed 35% year over year. Homes listed at $430,000 last year are being relisted at $360,000 with appliance upgrades, closing cost credits, and rate buydowns attached incentives that signal how far seller expectations have had to move. The city is also straining under its own rapid growth. Schools are overcrowded, traffic has worsened significantly, and utility systems are struggling to keep pace with the development that was built on the assumption that demand would never slow. Waterfront insurance now averages $6,500 annually, a cost that is derailing mortgage approvals and eliminating buyers who would otherwise qualify. The sun and beaches remain. The housing math no longer works for the buyers this market was supposed to serve. Number 3. Fort Myers. Fort Myers experienced one of the most dramatic pandemic-era housing surges in the state. Between 2022 and 2024, median prices climbed more than 65%, peaking around $430,000. Investors swarmed, builders could not keep up. The city seemed to embody everything the pandemic migration story promised. Then, Hurricane Ian made landfall, and the market that had been built on momentum began to feel the weight of everything it had been ignoring. Prices are now down 6% year over year. Inventory has expanded from roughly 3,200 listings to over 5,000. Homes are sitting longer, sellers are cutting prices, and contracts are falling through before closing at a rate local agents describe as the worst they have seen since the last housing downturn. The insurance situation in Lee County is the most acute in this countdown. Average annual premiums now run between $9,000 and $11,000. Even for properties outside official flood zones, a direct consequence of Ian's devastation and the reassessment of risk that followed it. Rental income that investors were counting on has weakened as tourism slows and Airbnb revenue declines. Short-term owners are listing at discounts just to exit before values fall further. Local incomes, with a median below $60,000, were never built to support the price levels the pandemic market reached. That structural imbalance has now become unavoidable. The Palm Boulevards and Gulf Sunsets are still there. The numbers behind them no longer hold together. Number 2. Street Petersburg. Street Petersburg built a reputation as Florida's creative city waterfront murals, independent restaurants, a genuine art scene, and the kind of urban energy that attracted a younger demographic who wanted Florida without the transactional feel of Miami. That identity drew buyers and investors who believed they were getting in early on something real. In 2025, the market built on that belief is facing its most serious correction in nearly a decade. Active listings have reached over 5,600, the highest level in almost 10 years. Median home values that peaked around $450,000 have fallen to approximately $390,000. The decline looks moderate in percentage terms. The stress underneath it is more significant. Flood insurance costs have risen 60 to 70% since 2023. Waterfront properties now face annual premiums exceeding $10,000, a figure that rivals mortgage payments in many cases and is eliminating buyers who would otherwise be financially qualified. Airbnb owners who purchased at peak prices are dealing with oversaturation, lower occupancy rates, and nightly rates that have been slashed as competition has increased. The median household income in Street Petersburg sits below $58,000. The market that was sold as accessible urban living has become inaccessible to the people who actually live and work there. Many buyers have redirected toward Largo, Clearwater, and other nearby communities where prices and insurance costs are more manageable. St. Pete's character is intact. Its housing correction is not finished. Number 1. Lakeland. Lakeland was the pitch that seemed too good to be true, positioned between Tampa and Orlando, affordable, growing, and positioned to capture spillover demand from two of Florida's most expensive metros. For a period during the pandemic boom, that pitch delivered. Then, it delivered too much. In just 2 years, inventory has jumped from roughly 3,000 active listings to more than 4,800, a 60% increase that has buried the market under supply it cannot absorb at current prices. Prices that climbed to $350,000 in 2023 are now declining 2 to 4% month over month. For homeowners who purchased near the peak or refinanced during it, that trajectory means negative equity arriving faster than anyone anticipated when they made the decision to buy. The overbuilding here was concentrated developers bet heavily on South Lakeland and Polk County, flooding specific submarkets with new subdivisions that assumed the buyer migration wave would continue indefinitely. When mortgage rates held near 7%, the buyer pool evaporated. Out-of-state migration slowed to a fraction of its peak. Local incomes, tied primarily to logistics and warehousing, did not grow fast enough to replace the demand that had been coming from elsewhere. Investor retreat has compounded the damage. Approximately 31% of current listings are investor-owned. Many of these were short-term rental plays or speculative purchases that are now being exited at discounts as holding costs exceed what the rental market can support. Panic selling is visible in multiple neighborhoods, with price reductions becoming routine rather than exceptional. Even without coastal exposure, Lakeland has not escaped Florida's insurance crisis. Premiums have risen more than 40% in 2 years, averaging between $4,000 and $5,000 annually, which for middle-income buyers represents a material monthly cost that pushes otherwise attainable homes out of reach. Conclusion: from Fort Lauderdale's eroding waterfront premium to Lakeland's overbuilt inland subdivisions, the story across Florida's housing market in 2025 is consistent. Prices rose faster than fundamentals could support, and the gap is now closing. 3 forces are driving the correction simultaneously. Mortgage rates near 7% have choked demand and pushed monthly payments beyond what local incomes can absorb in most of these markets. Insurance premiums have risen 50 to 100% since 2022, turning what used to be a manageable annual expense into a deal-breaking cost that is eliminating qualified buyers mid-process. And inventory built during the boom years is still arriving on the market at a pace that demand cannot match. This is not a collapse in the 2008 sense. There are no mass defaults, no overnight evictions, no single triggering event. What is happening is a rebalancing a market that ran on speculation and migration momentum, returning toward the economic fundamentals that actually govern long-term housing values. For buyers with the ability to wait and the financial patience to negotiate, opportunity is beginning to appear in markets that were effectively closed 2 years ago. For sellers who purchased near the peak, the window for extracting peak-era value has narrowed significantly. For investors who relied on appreciation and short-term rental income to justify their acquisition prices, the recalculation is already underway. What is happening in Florida today is not only a Florida story. The same forces: insurance disruption, rate pressure, overbuilding on migration assumptions, and the gap between housing costs and local incomes are present in housing markets across the country at varying stages of the same cycle. Florida is simply further along. Which of these cities surprised you the most? Drop it in the comments below. I read every single one.